Okay. Hi, good morning, everyone. And welcome to Bursa PLC's Investor Relations Series 9, Market Outlook, second half 2024. We are very delighted to have Miss Ivy Ng here with us today. Ivy is the Head of Research and Head of Agribusiness at CIMB. She has an extensive background as an investment analyst starting in 1994, and in 2018, she took an additional responsibility as the Head of Research and has consistently ranked highly in industry polls. She was ranked number 1 by Asia Money polls as the best Malaysian strategist from 2017 to 2022, ranked best plantation analyst from 2019 to 2022, best Malaysian industrial analyst from 2014 to 2018, and best Malaysian utilities analyst in 2007 and 2008, as well as best Malaysian material analyst in 2021. We are very honored to have her today. And before we begin this session, I would like to remind the participants that there will be a Q&A session at the end of this session. Please type in your question in the chat box, and we will address the questions later. Without further ado, please join me in welcoming Ms. Ivy. Ivy, I'll pass the floor to you. Thank you.
Yep, thanks so much, Meiki. Good morning, everyone. Firstly, I'd just like to thank Bursa for inviting me to speak at this event. So for today's presentation, I will run through a little bit on market recap, and then I'll run through some of the policies that was recently introduced by the government and take a quick look at what is the impact to the market. And then I will move on to talk a little bit about the recent corporate earnings season. And then I'll share with you a bit on our fund flow analysis, and I'll end it with sector recommendation and picks within the sectors. So let's start with the recap on the market. And I think Bursa has done very well so far this year. We are up close to 10%. You can see that this is a very strong performance, because if you look at the left-hand side of the chart, you can see that we had suffered 3 consecutive years of a decline before starting 2024. And if you track historical Malaysia market performance, we've never had a period where we had 4 consecutive years of decline. So I think this year, at the start of the year, everyone is anticipating that the market will do well, but I think the performance so far has exceeded some expectations. So not only are we doing well on the 10% gain so far on the 5 months of this year, we can also see that KLCI has outperformed all its ASEAN peers this year, and also the MSCI Asia ex-Japan index. What is also interesting to note is that if you study the index component that did well so far in the 5 months of this year, you'll find that the mid 70 index actually are the best performer within the indices. And this suggests that the stocks they are after the 30 largest, the 70 stocks after the 30 largest that make up the top 100 stocks actually did better than the top 30 largest stocks. And I think a good explanation on why this is the case is that if you look at the sectorial, you will find that the property and the energy, if you look at the 5 months performance on the sectorial indices gain, you see that construction, property, energy, transport, they were among the top performers. But these sectors don't have, in some cases, any representation in the KLCI, but they're all represented in the mid 70s. And so that's why in the earlier side, we saw that the mid 70 indices actually did better than the top 30. So if you take a quick look at this sectorial performance, you can see that sectors that are in favor and they have led to the strong market performance to some extent is driven by utility, construction, property and energy sector. And I think utilities in particular is driven by the energy transition plan, also partly by the currently the very strong addition of data centers in Malaysia. Construction did well because a lot of the project flows are coming back. We can see a lot of projects, orders coming through for large construction companies, and our analysts also from the upcoming Johor Singapore economic zone. And I would say these are some of the factors that drove up the performance of the market so far this year. Now, this is actually, I will be presenting a few fund flows data in this presentation, but this is just the first slide on it. And this is actually fund flows for the month of May. And what we want to show here is to see which group of investors are driving up a certain sector performance. So just taking you back to this slide, you can see that in May, let's say if we take a look at May on the right-hand side of the table, you can see that technology was the best performing sector in May. And if you want from a fund flow perspective and you wanted to know which group of investors behind the strong movement in the tech sector. So that is how we look at fund flow, one way of looking at fund flows, and that is just a very brief introduction of what we do on a monthly basis in terms of data points for our clients. Now, the other aspect that we look at on a market is to look at how big is the trading activities in the market, and we can see that actually interests are rising. And this you can see from the average trading value. If you look at the left-hand side, you can see that at the start of the year, on an average daily trading value basis, we are running in January about 2.7 B, but that has increased to about 4 B coming 2024. And if you look at it on a yearly basis, so we go back to 2020, where we had the COVID and so forth, and there was a lot of strong retail interest in the market. We were doing about 4.2 billion on an average daily trading value for the equity market. And then after the COVID, the value went down to 2 odd billion. Now for the 5 months, we've gone up to 3. So this is a positive sign. And in this data point, you can clearly see which group of investors are participating more in the market. And you can clearly see foreigner is one aspect of the investor group that have been more active coming back into our market. So this is actually to kind of look at the share of the different group of investors' participation in the market. And what you can see in the 5 months of 2024 on the right-hand side or the left-hand side of the chart is that the retail participation has dropped, but what we do see is that foreign and local institutional participation have gone up. And in particular, the biggest buy is actually, in terms of increase in participation, is actually the foreign investors. Now, this is basically to share the flows of the various group of investors on a monthly basis. So if you track them on a monthly basis, what we can see here, and in particular, I think a lot of interest centered on foreign investors flow into Malaysia because it means additional liquidity to our market if foreign investors were to add more funds or net buy more equity in the Malaysian markets. And what we can see is since July 2023, there's been increased net buy flows into the Malaysia equity market from the foreign investors. In particular, they were quite heavy buyers in November, July, and February. But they are also trading in our market. It's not like every month they're buying and they're not selling, but you can see that in March and April they were selling and then they are buying back into market. So it suggests to us that foreign investors are basically having a trading kind of mentality in the Malaysian equity market. And this is actually a picture on the weekly flows, where we try to track the behavior of the foreign investors versus the performance in the market. And generally, we do see quite good correlation in the sense that when you have foreign investors buying quite aggressively in the market, you will see that that week typically you have a positive outcome for the TLCI in general, not all the time, but most of the time we do see a positive correlation. And that's why I think we do try and track this data to get a sense of how overweight or underweight, perhaps in some instances, are foreign investors in the Malaysia equity market. Now, this is another way of tracking foreign investors' participation in market is to look at their shareholding level. You can see that foreign shareholding in Malaysia equity market is at all-time low at 19.6%. Although we've seen fund flow coming into the Malaysian market from the foreign funds, but we've also seen some exit of foreign funds out of Malaysia listed companies. For example, more recently, ANZ have sold their entire stake in AMB, and that would mean there's quite a lot of strategic foreign outflow of Malaysia. In particular, this is a strategic stake because they do have quite a big position in AMB before they decided to exit the stake. So most of it went to local institutional investors. And then we try to look at performance on a company basis. And in particular, we track the top 30 stocks that are in the KLCI constituents. Over here, you can see that for the month of May, the top performing stock is actually Mr. DIY, and then followed by YTL Corp. And we can relate then that performance again to the fund flows. And over here, we actually track the fund flows for the KLCI stocks. And in particular, if let's say we want to take a look at, say, Mr. DIY, which is bolded in this table, you can see that the big buying is actually coming from foreign investors. And if you're looking at, say, YTL, for this particular month of May, oh sorry, this one is April. So you can see that actually the top buyer is actually local instinct. So that's just how we relate fund flows to say performance, so that we can get some sense of the interest in that particular stock. Okay, and then we do that also on we do this monthly and weekly fund flows to our clients, and we also put in some of the top buys by this group of investors on a monthly as well as a weekly basis. Okay, so I'll next move on to talk a little bit about some of the policy that the government has introduced recently. I think the more recent one obviously is the floating of the diesel price that become effective on the 10th of June. So this is to save some of the subsidies expenditure and to prevent leakages on the subsidized diesel. So far, it appears that this exercise has been effective, and based on the Parliament response on the 24th of June, we gather that retail sales at petrol station has come down by about 8 million liters, about half of that loss here, 4 million liters increase. The other leakages could be to to outside of Malaysia. So it appears that the policy has been effective so far in perhaps reducing smuggled diesels and so forth. But bear in mind, the government are still bearing subsidies of about 10 billion. So although they save 4 billion, so original subsidy perhaps is about 14 odd billion. They are still subsidizing diesel of up to 10 billion according to the government. And you can see the breakdown of the 10 billion. So for Peninsular Malaysia, they still have the subsidy to the logistics sector selectively that will cost them about 4 billion. The removal of the diesel subsidy only applies to Peninsula. So subsidy in Sabah and Sarawak are still at 3 billion. And there's the fishermen diesel subsidies and the subsidies for the agri-commodity entrepreneur. So that is where we are with regards to the diesel subsidy removal for Peninsular Malaysia. In our view, some sectors could potentially be negatively impacted by this policy. And among the sectors that could be potentially impacted, we could potentially see perhaps slower sales for diesel car. Petronas Dagangan that sells fuel, diesel and petrol may see some decline in volume growth for diesel. I think you can clearly see from the 1 week statistic. It shows a 30% decline in diesel sales at the pump. Logistic players, although they may be getting some subsidy allocation, but our concern is that over time, this may not cover all their diesel usage. It's still unclear whether the government will provide unlimited subsidy for those in the logistics sector that qualify for SKDS, or over time there could be a targeted volume allocation and so forth. So the concern here is that if they don't get subsidy for everything, there could be a potential cost increase, and whether they can pass on those costs. For consumer companies, our concern is basically whether they get the targeted subsidy, and if they do get, then the impact should be minimal, assuming it covers everything. Then the second part is that some parts of the consumer goods may not be getting the subsidies, and the players may eventually need to pass on this cost to consumers. So consumer may experience higher prices and they may spend less. So that is going to be slightly negative for the consumer company. But our channel check suggests that logistic costs maybe make up about 5 to 8% of consumer companies' total operating costs. So we are hopeful that the impact, should there be any, is not going to be significant. Consumer staples, from what we gather, they should get the diesel subsidy, so we don't think they should be seeing a big impact on cost or the need to raise selling prices significantly. The other sectors that could potentially be affected by this fuel subsidy rationalization plan is potentially the property and the construction, because for the construction companies, like the transportation of building materials and so forth, they won't get the targeted subsidy allocation for diesel. So they will see higher transport costs, and this will be passed on to the construction companies, and they will have to raise prices. And same goes for property companies. So this is a bit on how we see the impact of the removal of diesel subsidy in Peninsula affecting some of the sectors. In terms of impact on CPI, is low because of the low weightage on diesel fuel in the CPI basket. It's only 0.2%. We think that there could be some second order effect, but that is very, very hard to predict. We think that what we should watch out for next is the RON 95 rationalization plan. Our in-house expectation is that this potentially could be implemented in fourth quarter. after the government announced it in the budget, which will be on the 11th of October. So that is our rough guess. Petrol will have a bigger impact because its share of the CPI basket is bigger at 5.5%. For 2024, we are now forecasting 2.3% for a CPI forecast. GDP, we are looking at about 4.9%. And OPR rate, we are looking at flat, no change until for the rest of the year. Just a very quick one on EPF Account 3 withdrawal. So this was announced in May, and there is a portion of opt-in so that you can have a one-time transfer from your account 2 to your account 3. And this opt-in option, yeah, for a one-time withdrawal, should you transfer to account 3, will end in August. So during this period, there could be, you could see potentially EPF members opting in, moving their funds from account 2 to account 3, and potentially applying the one-off withdrawal. Now, based on our check with EPF, the total amount based on the current funds that they have that could be withdrawn in account 3 because of this opt-in option and the introduction of EPF account 3, they estimate that to be about 57 billion. Okay, and this number is actually much lower compared to what we saw previous 4 withdrawals of 144 billion. So it's not as big as what we've seen in the past 4 withdrawals. From EPF internal estimates, they think that out of this 57 billion, only potentially 20 to 30 billion may be withdrawn. This is their internal experience based on, internal forecast based on historical experience. After that, because 10% of the EPF contribution will continue to go into account 3, they think that potential withdrawal after that on a yearly basis will be 4 to 5 billion. So our view on this is that we don't think this is going to have a big impact on the market, simply because the potential withdrawals is much smaller compared to the past withdrawals. And currently, EPF is seeing very healthy inflows of funds of 52 billion on an annual basis. So they can definitely cope in terms of liquidity from these withdrawals. We could see potential short-term leave for consumer companies because typically in the past, we do see that consumer spending actually go up with EPF withdrawals. But this is likely to be in the short term. And lastly, in terms of policies, we do see the Prime Minister announcing that they will give civil servant a pay increase starting December. I think they're going to announce some of the details probably in September. And why we are highlighting this is because the allocation for the hike of 10 billion is actually quite significant. It's roughly about 0.9% of consumer spending. So it's not here yet. It will come potentially in December. And if that happens, we think that potentially this could benefit consumer sectors, especially if the civil servants, decide to spend, most or all of the increase in their pay package. Okay, then the last one I just want to touch on is the first quarter earnings season. And I would say that we are quite positive on the outcome of the first quarter earnings season. So these are due to several reasons. Number one, if you look at the earnings revision ratio, so this earnings revision ratios, what we do is to track companies under our coverage that have achieved earnings that are above our analyst forecasts versus those that come in below our analyst forecast. So obviously, the higher the earnings revision ratio, the better. because it suggests that more and more companies are actually delivering earnings that are above our analyst expectations. So based on our tracking of the companies, our coverage in first quarter, we found that this ratio has gone up to 1.4 times. So this is a very high figures because it's better than what our tracking for first quarter earnings revision ratio for the last 10 years or so of about 0.5 times. This ratio is also higher than what we saw in fourth quarter of 0.9 times. So that's a reason number one why we think it's a positive first quarter earnings season. Number two is that we saw that actually the net profit for the companies under our coverage, if we add up all their net profit, they're up 17% year on year and 6% Q on Q. So we are positive to see that companies are actually delivering higher year on year earnings, double digit, and on a Q on Q basis sequentially. So this is coming from banks, construction, power, transport, gaming. So essentially, we are seeing generally most sectors are doing better. And in terms of those sectors that have a bigger number of companies that actually achieve better than expected earnings, so these sectors are performing much better than our expectations, are banks, building materials, and the oil and gas sector. And even those sectors that actually didn't do so well, so rubber glove and plantation are sectors that have seen more companies coming in below expectations. But even so, the guidance and the analyst expectation is that they are probably near their trough and they are going to see earnings recovery on a Q on Q basis going into second quarter. So those that are not doing so well are improving, and we do see quite a number of sectors that have delivered better earnings on a Q on Q and year on year basis. So that's why we feel that on an overall basis, this is a good outcome from the first quarter earnings season. So this table just gives you a flavor of how we look at results season, where we actually track how many companies within these sectors are doing better than our analyst expectation, those that come in below, and generally we are slanted towards more positive because especially the companies can deliver better than expected earnings. So that is a positive, to some extent, a positive catalyst for the market. Now, in terms of forecasts for the full year, we are looking at KLCI, which is just the top 30 stocks in the market, to deliver about close to 10% earnings growth for 2024. And this earnings growth of 10% based on our internal forecast will come mostly from the banking and utility sector. With Maybank, CIMB, Tenaga, YTL Corp, if we actually dissect the numbers that produce the 9.6%, you can see that these four stocks actually make up the bulk of the KLCI earnings growth. Okay, so that is quite a good figure. It's better than, say, the 2023 or 5%. Now, in terms of KLCI target, we are currently projecting an end year target of 1656. So this is 1656 is based on a PE of 15.4 times, and this is at plus 0.5 standard deviation above our 5-year mean PE. So I think a lot of questions we get sometimes is, how do you determine what PE we should give the market? Later I'll show you a PE band chart where we attempt to make our decision based on historical trading band, but also we put in qualitative and views on the market. And in particular, I think we are seeing improved political stability situation in Malaysia. I think that's a plus point, and that deserve a mean PE or slightly above a mean PE. I think we also have seen news flow, our Prime Minister asking GLC and GLIC to actually invest more funds in Malaysia. That is positive for the equity market perspective because it means you've got more liquidity in the Malaysian equity market. And when you have more liquidity, you can have higher PE valuation for the market. And the last one, of course, improving corporate earnings growth prospect. That is also positive for the market because investors buy into companies for their corporate earnings growth, dividends, and so forth. So if you have strong corporate earnings growth, it means also potentially better dividends as well as higher valuations for the company. So this is what I spoke of earlier. This is the PE band chart for KLCI. This goes back to 2004, so it's a long trend. And what we can see here is that if you go back to, let's say, the COVID, and earlier I mentioned a little bit about liquidity. So during the COVID, we got a lot of retail investors actually entering the equity market, and partly also because you have the glove makers rally and strong demand for glove makers and so forth. And you can see that when you have a lot of liquidity coming into the market, you can actually push the PE valuation of the market. At that point of time, we are hitting quite close to 3 standard deviation above the mean. Okay. Currently, we are only trading just about the mean or slightly below the mean. So we are not, let's say, expensive, but we're not like very cheap, which was, let's say, -2 standard deviation at this point of time, right? When foreigners were exiting the market, that kind of affected our market performance and liquidity in the market. So we fell to as low as -2 standard deviation. So typically, what we can see from the chart, right? What we can see from this chart is that whenever we see the KLCI hitting -3 standard deviation, which we saw during the global financial crisis, or during the period of COVID, that was the only 2 periods I can see in this chart where we had -3 standard deviation PE below the mean. This is a signal that we should buy the market. And when we do see perhaps the market trading at +3, which was at the peak of the COVID and the rally in the market, it suggests that it's overheated a little bit, and this is perhaps a signal in general that perhaps investors should take profit. Where we are today is not as cheap as what we used to trade at -2, but we are not actually, say, expensive. If you go back to period, say, when there was political stability, which is to go back to a period before, say, 2018, at that point of time, we were trading at, I would say, somewhere between -1 SD to +1 SD. So I would say there is a potential we could go back to +1 SD if a lot of these policies and investments starts to gain traction and more projects coming through. So this is actually the sensitivity analysis. So for those who look at KLCI targets, this is our calculation. We are currently putting our KLCI target at 1656 plus 0.5. But as I mentioned earlier, if you just look at history, it could potentially go to +1 SD. In the past, it has done so. When we have more political stability, if that happened, you're looking at 1736. Yeah, KLCI target. Okay, so yeah, okay, so I will just quickly just go through these last 4 slides. And basically over here, what we try to do, and of course this is available in our notes to our client on a monthly basis. What we're trying to do is to see whether there's certain trend in a particular investor group and how to write on some of these trends. So essentially, if you look at local institutional investors, and this is the monthly net buy or net sell of that particular institutional investors, local institutional investors as a group into the various 13 sectors in the equity market. So what we can read from here is that local institutional investors are generally positive on industrial product sectors. They have been net buyer in these sectors for 6 months. And they are generally, you can see that they are generally quite a consistent net seller in the transport sectors. They've been selling for the last 4 consecutive months. And also from here, you can roughly see some of their interests. So for example, they are buying plantation and they've been buying it consecutively, suggesting that perhaps they're accumulating in a particular sectors. Okay, but I think the more interesting one perhaps is the foreign investors sector of fund flows. And what we can see here is that foreign investors are generally interested in thematic. And what we can see here is that their biggest buying since June, July last year has been the utility sectors. Okay, so if you just take a look at the last column, right, you can see that they've been buying the utility sector since the NETR roadmap was announced sometime in August. But I think prior to that, there was already news that the government is announcing the National Energy Transition Roadmap. So you can see that utilities since July is a positive. They've been buying and quite aggressively, and then you can see that the numbers continue to go up. Right, there were only one net sell month throughout the whole period that we're looking at from July 23 until May 24. Okay, and the other sectors that they are also very keen on is the property. Now, this is interesting because property is not a very big sector in the scheme of things in terms of market cap share of the overall Bursa Malaysia market. But you can see that they have been net buyer of the property since June 2023. Every single month, foreign investors were buying the property sector, net buying, meaning they could be selling, they could be buying, but on an overall basis, they are putting more money into the property sector. And this could be because of the Johor Singapore Economic Zone plans that has boosted interest in property. Also, the NETR suggests that, you know, you probably need some land for the solar farm, and also you're selling land for the data centers. So there's opportunity for property developer to unlock value, also for growth opportunity. So what we can say from this kind of trend analysis suggests to us is that foreign investors are coming into Malaysia. They like the thematic stories. They're putting money into thematic stories. They're not putting money across all sectors. There are some sectors where they were selling in Malaysia. For example, I think they're not so positive on the consumer, probably because of the subsidy rationalization plan. And you can see that they've been generally sellers in the consumer sectors. We also noticed recently they've been seller of the financial services sector. Okay, so maybe just a last one, just touch a little bit on the retail investors flows, and we can see that I think one interesting point that we noticed about fund flows is that retail investors have been net seller in the market for most of this year. So they've been the largest net sellers. And in particular, I think in terms of trend, you can see that they are big seller of the property, a big seller of the utility sector. So what the foreign investors are positive on, retail investors are taking profit on. Okay, so this is the last slide, just where we are in terms of rating for the various sectors and our topics. I won't go into details in the interest of time, but generally we are overweight on the banks, the construction, generally the local sectors. We are positive. Okay, so I'll probably stop here and pass back to Mei Chi and take any questions.
Yeah, thank you, Ivy. Yeah, it was an insightful webinar, and for sharing your insights on the market. Um, so it's actually very good to hear that the market in the second half would be very positive. Um, yeah, so if there's any question, I would like to remind the participants that you can type your questions in the Q&A box or the chat box. Then we will read out the questions for you. We will answer the questions for you. Actually, there's one question. Um, so the participant asked that any reasons why the plantation sector is not doing well this year?
Sorry, the plantation sector, yeah?
Yeah.
Okay. I think a lot of investors that we met, I think generally for plantation sector, I think one of the difficult part for investors sometimes is to forecast the CPO price. So I think for this year, the plantation sector, I think a lot of the investors were thinking the prices are not rallying, so to speak. So I think the assumption is going to be, for us, the assumption is going to be slightly better at 3,900 ringgit per ton for this year versus last year, 3,800 plus. So it's not super exciting for the local investors. And I think they are concerned about perhaps the EUDR, and also they are a little bit of concern about the minimum wage hike that could potentially happen in the later part of this year in terms of impact to cost. But we have a slightly contrarian view to the market. We actually have an overweight call at this moment on the plantation sector. We think that there is, I think in general, we think that market has overlooked the potential in terms of earnings growth for the plantation for this year, because they are actually enjoying lower cost of production and they are seeing higher output due to the return of foreign workers. I think in general, the market has overlooked this because they are concerned about external policies like UDR and so forth. So we think that this sector could potentially gain traction in the second half of the year when the plantation companies actually deliver the earnings from the lower cost, which is not yet visible, I would say, in the first quarter, because first quarter you have low production. Yeah, so that's how we see it, and now that's how we are contrarian to the market.
Okay.
Also, I think just the last point, prices have been quite subdued, but we think there is a potential that it could rally due to weather issues. But this is obviously, weather is probably hard to predict.
Okay. Yeah. Thank you, Ivy. There's one more question. What are the key risks to the market that investors should look out for?
Okay, I think key risk to the market, I guess one of the factors that we see in the past that really affect the market performance has been the ringgit and the foreign funds. So what we notice is that since say some years back, there was concern about 1 MTB and so forth. During that period, we noticed huge outflow of funds out of Malaysian market. And during that period, when there's huge outflow of funds, we noticed that the market valuation slowly kind of being affected because of less liquidity in the market. And when we speak to foreign funds, one of the key things sometimes they like to ask us is how we think the ringgit will perform, or what do we think is the end, what is the ringgit going to do for year end? Are they going to appreciate and so forth? Because we feel that ringgit, because their performance are probably, for foreign funds, are probably linked to US dollar. So the performance of the ringgit plays a part in their performance. So what we notice is that when ringgit depreciate and foreign funds outflows, we tend to see a foreign fund outflow. That is a key risk to the market. Then you potentially can see market actually coming off. The other risk we noticed in the market over the past few years has been taxes. if let's say government introduced more taxes that impacted the earnings of corporate Malaysia, there could be some market reaction to that. Or for example, if let's say there's an introduction of capital gains tax, I think there was a rumor of some of this in the past. If if that happens, we could see market reacting negatively. The third point, I think, in terms of risk that has actually happened in the past, also include, for example, if you have corporate earnings coming in below expectations, or corporate earnings actually showing earnings decline year on year due to whether it's taxes or any other factors, that is also negative. So there's a key risk to the market. The other risk, of course, is political. If there's a constant change in the government, and that leads to potential change in policies and so forth, is also will be a key risk, a negative for the market. Other risks that we've noticed in the past include, for example, geopolitical risks, war, and so forth. Sometimes we could benefit a little bit from the geopolitical risk, but in general, if the global economy come off due to all these geopolitical risks, then it's overall negative for the market, even though we may benefit from some of the companies actually positioning their factories in Malaysia and so forth, or diversion of trade. Okay, so those are some of the key risks.
Okay. There's one question from Abdul Rahman. He would like to understand how analysts analyzes. So what are the factors that analysts consider when they pick a counter to cover for their research and recommendation?
Yeah, okay. So we are, well, at least I speak for our house, but I think that should be generally practiced across all other houses as well. I guess one of the thing is investability. So the company must have certain liquidity. The market cap must be of a certain size, because we actually service quite a lot of institutional clients. So that is also the requirement of our institutional clients. So one is, of course, the size and the liquidity, so that should we cover the stock, there'll be an audience for the stock in terms of our client base. That's number one. Number two, of course, the company has to be transparent in their disclosure for us to be able to build the earnings model and also forecast the earnings and derive our fundamental valuation for the company, so that we can actually make the recommendation to our clients. So accessibility to the company and the availability of the information that we need to make our analysis is also important in our consideration to cover whether we cover the company. I would say the third point is, of course, the prospect of the company, so, and the business model. So I think a lot of time our company, when we pitch our investment stock idea to our clients, they will ask us, why this stock, why should we be looking into this stock? So the company has to have the investment proposition, they are unique, they are attractive, for us to think of whether we should cover it and promote it to our investor base. And of course, the outcome that all our clients are looking for is a positive outcome. Yeah, so generally interesting stocks, business proposition, strong growth. Yeah.
Okay. Priya from Petronas Gas would like to know how severe is the subsidy rationalization likely to increase CPI or inflation? If so, what would it mean to the trading activities in utilities and also energy-related stocks?
Okay, so I think the stocks that are most affected in terms of, let's say, if your retail sales of of fuel at the pump is affected. Amount of coverage is actually Petronas Dagangan, yeah, to some extent. But essentially, we are tracking the data that's coming out from the government as and when they share it, to see how severe is the decline. But so far, I think from the numbers that was briefly shared recently, it appears that on an overall basis, just on the first week, but this is not very good data because people could be using up their stocks and so forth in the first week after the price change. We are looking at 15% decline in diesel sales in Peninsular Malaysia only, right? So I mean, it looks quite significant, but I think over time it will kind of settle down as people re-look at their business model and their diesel usage. So in terms of CPI, diesel fuel has a very low weightage on the overall CPI, so it's not big. It's only 0.2% of the overall CPI weightage. So our calculation is that if you assume 50% increase, you're only gonna move your CPI number by 0.1 percentage point. But we are mindful, of course, this is just talking about diesel. If you actually look at the second order effect, it could be more significant, but it's very hard to predict the second order effect. So we have to continue tracking the news and see who are raising prices and whether the government will then try to capture them into their subsidy scheme so that they can actually moderate the price increase, or this is going to be sticky and therefore we should start applying that into our inflation figures. More concern, of course, is around 95. Over here, we mentioned that currently it's about 5.5%. So it's 0.2% is the weightage for diesel. Our economists say that for the CPI basket, the share for petrol is 5.5. Also, we need to see whether they're going to apply only for Peninsula or Peninsula Plus East Malaysia, because it does have a little bit of impact on the CPI for the whole country. But petrol is a bigger one. But we don't think they'll float petrol all the way up like diesel. We think it's going to be slightly staggered. So to get people to kind of adjust slowly. So that's our view. But I think the government is keeping this information very close to their chest.
Okay. So the US had the presidential debate this morning. So Charles here would like to know how would the outcome of the US presidential election is going to affect our local board's performance and also the regional business environment.
Yeah, I guess it really depends on what kind of policy whoever win the presidential election and how that policy is going to impact the global trades. And for example, I would say if Biden recently introduced import duties on China gloves, and also limited the trades with semicon and so forth, and that is seen to be a positive for Malaysia. So if he continue on and this policy stays, then we could potentially see some benefit going into the next few years once that new tariff is applied, limiting China exports of certain product to US, and Malaysia could potentially benefit. So in that sense, it could benefit some sectors, which is already known to the market at this moment. And market to some extent have started, pricing in some of these potential. But let's say if alternative president wins this coming election, then we have to probably watch very closely which direction it's going to take on all these policies and how they will affect the Malaysian company listed over here. Yeah, I think that will be how I will see the outcome to our market. Also, I guess you have to look at it also on the direction of the Fed fund rate. Obviously, if the rate come down, as people are expecting, but now, earlier it was up to 6 cuts, now it's 1 cut. If you have lower US rates, it will be more favorable to our ringgit, and that could benefit some of the companies that are having, forex losses due to US dollar debt and so forth. So that could also be a positive. So I would say we will look more into each of the president's policy direction, eventually they actually apply them, and how each of these policies is going to affect Malaysian companies, and then go and recommend those that we think will benefit, and those that are going to be negatively affected also mention that, and that could then be translated to potentially impact on earnings and sales going into the next few years. So that's how I would look at it. Yeah.
Okay. In the interest of time, maybe we take one last question. So we have a question here on IPOs actually. So yeah, he asked that the recent IPO saw high oversubscription rate. Do you think that the retail participation is short term, or investors are more savvy now, looking for more group stocks?
I think definitely investors, I would say, is more savvy over time because there's so much more, platform or brokers are offering more kind of outreach program, in terms of having more seminars for retail investors to understand more about the companies that they are investing in. So definitely, I think that has definitely added knowledge to investors who are buying shares in the stock market. So I would say incremental improvement to the knowledge sharing platform that we have in the Malaysian stock market, and therefore I would like to think that retail investors have turned more savvy, and also with the social media and so forth, there are definitely more information available out there for them to make better investment decisions. So I would say they're more savvy, and they have there are more transparency as well because the companies are coming direct to speak to retail investors, as we've seen over the last few years.
Okay. So I hope so thank you, Ivy, for
Yeah,
sharing your insights. And also thank you the participants for all your questions. Yeah, I hope that today's event has given you a clearer picture of the market for the second half of the year, and to help you best position your investment as well in the second half of the year. So we would like to also remind the participants that to visit our Bursa Malaysia IR for You website, where the recording will be uploaded and also the slides could be uploaded as well. So there are many resources available to help you on this journey as well. Please go to our Bursa Malaysia IR for You website. Thank you again and have a great day.
Yep, thanks everyone. Thank you.